Have you ever heard the saying, if it sounds too good to be true, it probably is? Well, that's exactly what we need to discuss when it comes to Wall Street's latest pitch for your retirement money, private equity in your 401k plan. Welcome to the Retirement Learning Lab. I'm Van Richards, and today we're talking about a controversial topic that could affect millions of American retirement savers. Should private equity be in your retirement account? Investment giants like BlackRock, State Street, and Empower are all pushing to add private equity to target date funds, claiming that it could boost your returns. But there's a lot more to this story than they're actually telling you. Before we get started, I need to let you know that everything that we discuss today is purely educational, and it does not constitute investment, legal, or financial advice. I want to help you to understand this complex topic so that you can make informed decisions about your own retirement savings. Be more about Wall Street's needs than your retirement security. So let's begin with this. Picture this. You're saving diligently in your 401k. You're putting money into a target date fund. You know, it's one of those investments where you just set it and you forget it. The investment automatically. So let's begin with this. You're saving diligently in your 401k. You're putting money into a target date fund. You know, it's one of those investments where you just set it and you forget it. The investment automatically adjusts as you get closer to retirement. It's been working fine, growing steadily with a mix of stocks and bonds. Now, however, investment giants like BlackRock, State Street, and Empower, which is actually the second largest retirement provider in the country, are saying that they can make your retirement savings grow faster, and they can do that by adding private equity. State Street has already begun its Target Retirement Index Plus strategy. Get the name? Target Retirement Index Plus. And Empower expects to offer private equity through its collective investment trust. You'll see that abbreviated as CIT. Now, not all of the CITs will have private equity, and I'm sure, or at least I hope, that they will clearly identify that they are actually adding private equity or offering private equity. Here's the carrot that all of these providers are dangling. These big investment providers are saying that they may be able to add an extra 0.5% to up to 2% returns per year. Now, over 30 years, that could mean tens of thousands, and for some of you could mean hundreds of thousands of dollars in retirement. Sounds pretty good, right? Well, here's where we need to pump the brakes and ask some tough questions. Let's dive deeper and discuss what they're saying versus the actual reality that exists. What the big providers are saying is this. Many of these big investment providers are saying that they can boost your target date fund returns by adding 10 to 20% of private equity. Now, they're claiming that that'll increase your returns by 0.5% to 2% annually. The math is different. Here's where it gets interesting. Based on analysis from financial experts, to get 1% boost in returns, you'd need to add about 25% of your retirement money in private equity. To get to 2%, they're talking about adding a whopping 50% of your money has to be locked up in private equity. Let me put that into perspective for you. If you have $100,000 in your 401k, they're talking about putting $25,000 to $50,000 of that into private equity where you can't touch it for a decade. I see three really big problems about this. Here's the first problem. The fees are absolutely crushing. This is where things get really concerning. Private equity typically charges what they call 2 and 20. That's 2% management fees for every year plus 20% of any profits. Now, let's put that into perspective. According to a benchmark survey from 401k averages, Target date funds vary in their fees a lot, depending on actually your employer's plan. Some of the lower price plans offer target date funds with as low as 0.08%. That's really small. While smaller employers, they have to charge larger fees, and they can be upwards of 2% or more. Here's where it gets absolutely bonkers. When you add private equity to your target date fund, those 2 and 20 fees, well, they stack up on top of each other. So if your current target date fund is charging you 0.5%, and they add private equity, you could be looking at total fees of 2.5% to 3% or even higher on the private equity portion. So we're talking about fees that are 10 to 25 times higher on the best target date funds, and on those with higher expenses, 2 to 4 times higher. Here's a real example. If private equity earns 8% a year, after paying those 2 and 20 fees, you're only probably going to see about 5 or 6% in returns. Meanwhile, if the stock market earns 10% and you're in a low-cost target date fund, you keep almost all of that return. So here's the second problem that I see. Your money gets trapped. Remember how I said that private equity locks up your money for 5 to 10 years? This is creating a huge problem for 401k investors. What if you lose your job? What if you have a medical emergency? What if you live near the coast and there's a hurricane and you have to use a lot of your retirement savings to live off of? What if the stock market crashes and you want to rebalance your portfolio? Too bad. Your money's tied up. This is especially dangerous for people that are approaching retirement. If you're 55, let's say, and half of your 401k is in private equity, you might not be able to access that money until you're 65. But here's where things get even worse. Not only is your money trapped, but those liquidity restrictions are going to absolutely destroy the returns that the big providers are hoping to make for you. The anticipated return absolutely falls apart. Here's where the math gets really ugly, and it's something that Wall Street doesn't want you to think about too carefully. Remember how I told you that adding private equity could boost your returns by 0.5% to maybe as much as 2% a year? Well, here's the massive catch that they're not advertising. To handle withdrawals, these funds have to keep 10 to 20% of your money in cash or liquid investments. It's what they're calling a liquidity sleeve. Think about what that means. You're paying private equity fees on money that's just sitting in cash. So let's say that you have $100,000 in a target date fund with 20% in private equity. Here's what you actually get. You're only getting $16,000 in that private equity because $4,000 has to sit in cash in that liquidity sleeve. $80,000 is going to be put into the regular stocks and bonds like they normally do. So you're not really getting 20% in private equity. You're only getting 16%. And that $4,000 in cash, it's earning maybe 3% in low interest rate times. It's earning zip, while you're paying 2 to 3% in private equity management fees. The return boost absolutely evaporates before your very eyes. Even worse, during market stress, when people want to withdraw money, that cash sleeve, well, it might need to grow to as much as 30% or more. Now, your private equity allocation is mostly cash, but you're still paying those premium fees for that money just sitting in cash. This kind of reminds me of something that I went through recently. I took my wife to a really fancy high-end steakhouse here in Houston. I was excited about it. My wife was excited about it. We were celebrating, and I ordered the surf and turf, and I was expecting, a proper steak. Before the main course came, they brought us this huge loaf of bread with butter, and I'm thinking, okay, nice appetizer. Then when the surf and turf finally arrived, I got this steak, and I kid you not, it was about the size of a silver with about a tablespoon of crab meat on top. I was so disappointed. And to beat all, the whole meal for the two of us cost about as much as we would spend on groceries for a week. Now, we went for the atmosphere, we were celebrating, and we wanted to have a nice night out. So it was okay. But I think you get the point that I'm trying to make. With these private equity target date funds, they're selling you the surf and turf premium private equity exposure. But what you are actually getting is mostly bread. It's that liquidity sleeve full of cash and bonds with a tiny portion of what you actually ordered. And you're paying premium prices for the whole thing. The liquidity sleeve doesn't just reduce returns, it can completely destroy the entire rationale for adding private equity in the first place. And here's the third problem. The risk is much higher than advertised. Here's something that the marketing materials don't emphasize. Private equity is much riskier than regular stocks and bonds. While a typical target date fund might have what's called a standard deviation, that's the measure of risk of about 15%, adding a significant private equity can push it upwards to 20% or more. Now, technical terms like standard deviation can be really confusing. So let me explain what that means in plain English. Your account value could swing up and down much more dramatically. In a bad year, instead of potentially losing 20% or 25%, which is really scary already, you could lose 35% or more. And here's the kicker. Recent data shows that from 22 to 2024, private equity actually performed worse than the stock market, earning only 6.8%, while the S&P 500 produced 12%. Now let's talk about what I think the real motivation is here. Is it because Wall Street suddenly cares about your retirement? Well, not exactly. You see, there's $12 trillion sitting in American 401k accounts. That's trillion with a T. Private equity is having trouble raising money from their traditional investors. That is, the wealthy people out there and the institutions. Some critics, including financial commentators on social media, are calling it a bailout, a way for struggling private equity firms to access regular people's retirement money. Think about it this way for a moment. If these investments were so good, why do they need to be marketed in the average 401k? Wouldn't wealthy investors be lining up for them? Here's what the experts are saying. The financial community is really kind of divided here. Morningstar analysts have expressed some concerns about the complexity in the fees. There's quite a few ERISA attorneys out there that are worried about the fiduciary liability for plan sponsors, that's the employers. And financial advisors, they're questioning whether these benefits are for the participants or for the investment companies. Even some former private equity executives have warned that retail investors might not understand the risk that they're taking on. You think? So this leaves us to question, is there really a better path forward? Look, I'm not saying that all alternative investments are bad, but for most people saving for retirement, the tried and true approach still makes the most sense. Keep these three things in mind. First, keep it simple. Stick with low-cost diversified funds. Second, stay liquid. Don't tie your money up that you might not need to. And third, focused on cost. Every dollar that you pay in fees is a dollar that's not growing for you in retirement. If you really want exposure to private equity, consider this. You can buy stock in publicly traded companies that do private equity, like Blackstone or KKR. You get some exposure without the fees and the liquidity problems. All right, that's my analysis for today. Remember, this information is for educational purposes only. Always consult with a qualified financial advisor for your personalized guidance. Now, if you found this helpful, please subscribe and hit the bell icon for notifications. And let me know what you think about this. Has your employer mentioned adding private equity to your 401k? I'm Van Richards, and thank you for joining me today on the Retirement Learning Lab.